Now we need to go over some basic terminology. So let's go over one of the most important terms. What is debt service coverage ratio, or DSCR? Well, it's a key financial metric used in commercial lending to measure a property's ability to generate enough income to cover its debt obligations. And in residential, this is called DTI, or debt to income ratio. In commercial lending, this is called debt service coverage ratio. It's a fancy word for something very simple, okay? So we're going to see how it's calculated now. It's basically calculated as the ratio of the property's net operating income, or NOI, to its total annual debt service, or principal and interest payments. So the formula is as follows. DSCR, which again is debt service coverage ratio, equals net operating income, or NOI, divided by total annual debt service. How to interpret DSCR? So basically, if the DSCR is greater than 1, the property generates more income than is required to cover the loan's debt service, indicating positive cash flow. And this is what most lenders will require. We might or might not talk about in this course about no DSCR loans, but in this case, we want to get good at what we will focus on, which is being able to master DSCR. And maybe we'll have some examples later on as to having some no DSCR loans. Now, if the DSCR equals 1, the property generates just enough income to cover the debt payments. And I'm going to show you an example real quick in just a second, okay? But first of all, let's cover the difference between having greater, equal, or less than 1 DSCR. So DSCR less than 1, the property's income is insufficient to cover its debt payments, indicating a higher risk for the lender. For example, if a property has an NOI, or net operating income, of $500,000 and an annual debt service of $400,000, we would have a DSCR that equals 500,000 divided by 400,000 would equal 1.25, which means it generates a positive cash flow, and this is what we want. This will be a common example when you do commercial loans, and this is something that you need to master time and time again. Why is DSCR important to a commercial loan underwriter? First of all, assessing the borrower's ability to repay the loan. So DSCR helps underwriters determine whether the property can consistently generate enough income to cover the loan's debt obligations. Are you going to be able to pay the debt time and time again? A higher DSCR, which we just did the example, a 1.25 or higher, indicates that the borrower will definitely be able to make the loan payments even during periods of reduced income or unexpected expenses. 2, mitigating lender risk. When it comes to loans with a DSCR below 1, which are typically considered high risk because the borrower is going to need to rely on external funds or their income or reserves to be able to make their payments, this is not what the lender's looking for, okay? You want to make sure that as an underwriter, you use the DSCR as a safeguard to ensure the loan is backed by sufficient income. That way you protect the lender from any future or potential defaults. Number 3, establishing loan terms. DSCR plays a critical role in determining the maximum loan amount, or loan to value, which is also known as LTV ratio, interest rates, and other terms. Higher DSCRs will probably result in more favorable terms for the borrower. Okay, so when the DSCR is above 1.25, then the borrower will have a lower interest rate. That's basically what we're saying here. Number 4, evaluating property performance. DSCR gives insight into how well the property is performing financially. A strong DSCR basically indicates sufficient or efficient management and stable income, while a weak DSCR or a low DSCR below 1.25 or below 1 may signal that there are potential problems and high vacancies or poor tenant quality. Number 5, compliance with lender guidelines. Most commercial lenders have a minimum DSCR requirement, often 1.25 or higher, to be able to get an approval on a loan. So you as an underwriter, if the DSCR is above 1.25 and that's what your employer requires, then you would definitely approve the loan on that specific topic. Meeting or exceeding the required DSCR is critical for loan approval, refinancing, or restructuring or structuring terms. When it comes to the underwriter, DSCR is an essential tool for evaluating the viability and risk of a commercial loan. This ensures that the property generates enough income to cover its debt obligations. So this provides security for the lender and reduces the likelihood of having a loan that goes into default. A strong DSCR typically leads to higher loan approvals and better terms, making it a cornerstone of commercial loan underwriting.